Even though it may look like the market goes up and down randomly, the points at which the price changes its direction are actually usually Fibonacci retracement points. Fibonacci is a mathematical sequence that has fascinated mathematicians for centuries. It is a sequence of numbers where each number is the sum of the previous two numbers. So an example of this would be 0 and 1 making 1, 1 and 1 making 2, 2 and 1 making 3, and so on. Some of these numbers may seem familiar because they are commonly used as values for indicators. What makes Fibonacci so interesting is that it appears in many different aspects of nature, from the spiral pattern of a seashell to the shape of a human's face. In the trading world, Fibonacci retracements and extensions are popular tools used to identify potential price levels where a market may experience support or resistance. In this video, we will showcase how the Fibonacci indicator works, how it can be applied for trading, and profitable strategies to incorporate it with. Let's first go over how we will add the Fibonacci tool to the chart. To do this, we will first need to head over to the left side of the screen where the toolbar is located. Now click on the arrow to unfold the hidden tools and select the Fibonacci retracement tool. Once you have done that, you will be able to click anywhere on the chart to add the Fibonacci retracement to the chart. If we now double-click on it, we will be able to see the settings. The numbers you see are the levels or zones that are usually referenced when using the Fibonacci tool. The numbers might seem random, but they are actually based on something called the golden ratio. We can find the golden ratio by taking a look at the previously shown number sequence, where the next number is the sum of the two previous numbers. If we divide any number by the previously shown number, it will be equal to 0.618. This is known as the golden ratio. However, if we divide the number by the second number to the right, this will result in 0.382. In fact, all of the numbers on the Fibonacci tool except for 0.5 are derived from a mathematical calculation involving the Fibonacci number string. Now that we know exactly what these values mean, let's take a look at how we will be using the tool. You have probably noticed that the price action moves in wave-like patterns. This is why we will be plotting the Fibonacci whenever a new wave is created. To be able to spot the end of the wave, we will be looking for a point in the price action where the price switch trends. As you can see here, instead of making lower lows, the price started making higher lows, showing us that the trend has been broken. We will be plotting the Fibonacci retracement from the lowest point to the recent major swing high. Since we want to know the general levels, it does not matter if we draw it from the wicks or the close. As you can see, if we extend the Fibonacci retracement into the future, the market uses the Fibonacci levels as support zones. It will also usually be the case that the price reverses and continues the previous trend while it's in the golden zone, which is between the 0.5 and 0.618 levels. As you can see here, this was indeed the case. Since we won't be using the Fibonacci levels outside of 0 and 1, let's disable these levels to make the chart less cluttered. To do this, simply double-click on the Fibonacci and uncheck the unwanted levels. To use the Fibonacci in bearish markets, we will first search for an uptrend. We will be looking for the exact point at which the trend switched to a downtrend. As you can see, this occurred here. This is because instead of making higher lows, the price made a lower low. Now let's plot the Fibonacci on the chart. We will be plotting the Fibonacci retracement from the highest point of the uptrend to the most recent major swing low. As you can see, the price made a pullback to the golden zone before it continued in the downward direction. The second way of drawing the Fibonacci retracement is a little less complex. For this method, we will first need to identify and determine what the dominant trend is. In this case, we see that the dominant trend is bullish. Secondly, we will need to identify the major swing highs and lows. In this case, we see that these occur here. Now select the Fibonacci retracement tool and draw it from the swing low to the swing high. Keep in mind that we will draw it from the swing high to the swing low if the trend were bearish. As you can see, with this strategy, we eliminate looking for a reversal and instead just look for a dominant trend. Before we take a look at strategies to use the Fibonacci with, let's first go over some situations where it shouldn't be used. To use the Fibonacci tool correctly, it's important to understand that it should not be used on small moves on lower time frames. Here we see an example of this. We are currently on the 1-minute chart and can see that the trend has switched from bearish to bullish. However, if we take a close look at the trend, we can clearly see that the trend was short and the price action didn't make large moves during the rally. For the sake of the example, let's ignore this and see what would happen if we were to draw a Fibonacci retracement here. We will be drawing the Fibonacci from the lowest point to the recent major swing high. As soon as we extend the Fibonacci into the future, we can see that the levels of the Fibonacci no longer provide consistent support. This is because the levels are so close to each other. That's why it's important to not use the Fibonacci retracement on small moves with lower time frames. Now that we know how the Fibonacci retracement tool works, how to use it, how to read it, and when we shouldn't use it, let's take a look at a strategy that the tool can be used with. But before that, if you are looking for a broker that has extremely low commissions and spreads, then check out Ninjatrader, the best broker to trade forex, indices, commodities, or crypto. They have live chat support so that any questions you may have can be quickly and easily answered. One of Ninjatrader's most prominent promotional offers is the matching deposit bonus that can be claimed when you open an account with Ninjatrader. Sign up via the link in the description to register with Ninjatrader and get access to all of these perks. For this strategy, we will first need to add a moving average to the chart. To do this, head over to the Indicator Search tab and search for the exponential moving average. Select the indicator made by TradingView and add it to the chart. Now navigate to the indicator settings. Here we will be changing the length of the indicator to 200. Finally, we will also be changing the color of the moving average to make it more visible. That was all that we needed to do. Now let's take a look at when to enter into a buy position. Firstly, we will need for the trend to be bullish. This means that the price must be making higher lows. It's also important for the price action to have gone above the exponential moving average. If this is the case, we will look for the recent major swing high, which we can see occurred here, and the recent major swing low, which occurred at this point. Now that we have spotted the swing highs and lows, let's draw the Fibonacci on the chart. To do this, let's select the Fibonacci tool. After that, we will be drawing the Fibonacci from the swing low to the swing high. Now we will need for the price action to pull back into the 0.5 or 0.618, which shows us that the price is near or in the golden zone. It is also important that the price action does this along with pulling back to the moving average as confluence. We can see that this happened here. We will enter into the position once the candlestick crosses and closes above the 0.382 level. This occurred here, so let's enter into the position. We will be placing the stop loss at the 61.8 level, and for the take profit, we will be targeting a 2 times risk to reward ratio. Now let's see how the trade plays out. For a sell position, the following conditions will need to have been met. Firstly, we will need to determine that the trend is bearish, meaning that the price is making lower lows. Along with this, we will need the price action to have gone below the exponential moving average. We can see that this occurred here, so let's now look for the recent major swing low and the recent major swing high. Now that we have spotted the swing highs and lows, let's plot the Fibonacci on the chart. Since this is for a bearish position, we will be drawing the Fibonacci from the swing high to the swing low. Now we will need for the price action to rally to the 0.5 or 0.618 level, which shows us that the price is near or in the golden zone. It is also important that the price action does this along with rallying back to the moving average as confluence. We can see that this happened here. We will enter into the short position once the candlestick crosses and closes back below the 0.382 level. This occurred here, so let's enter into the short position. We will be placing the stop loss at the 61.8 level, and for the take profit, we will be targeting a 2 times risk to reward ratio. Now let's see how the trade plays out. I hope this strategy could show you how you can incorporate different indicators with the Fibonacci tool. Please remember to also test a strategy before using it in live markets. If you enjoyed the video or learned something new, please leave a like and subscribe to the channel. If you have any questions, feel free to leave a comment.